The two-bucket system. Why rich people never mix risk capital with long-term wealth. Billionaires have two separate accounts. One for calculated risks, one for safe compounding. Mixing them is how middle-class investors blow up their retirement. Here's the psychology behind why separating your money is the smartest thing you can do. Hey, welcome back to lIHITRO Bank. My name is Adam. Michael Sonnenfeld runs Tiger 21, a network of ultra-wealthy investors with $160 billion in assets. He says wealthy investors commit to their investments for the long haul instead of chasing quick profits or reacting to market noise. They don't panic when markets drop. They don't sell at the bottom. They stick to their plan because they've already separated their money into two buckets: risk capital and long-term capital. Here's how it works. 10 to 20% goes into your risk bucket. This is money you can afford to lose completely. Startups, crypto, high-growth tech stocks, angel investments, speculative plays. The kind of stuff that could 10x or go to zero. The other 80 to 90% goes into your long-term bucket. Index funds, blue chip dividends, real estate, bonds, boring stuff that compounds slowly over decades. This is your retirement security, your kid's college fund, your financial foundation. The genius of this system is psychological. When you have permission to lose money in your risk bucket, you don't panic. You can watch Bitcoin crash 50% and not touch your retirement account. You can invest in a start that fails and not blow up your whole life. The emotional separation keeps you rational. You're not making fear-based decisions with money you need for groceries. Most people do the opposite. They put everything in one account and try to manage risk across the whole portfolio. When the market crashes, they see their entire net worth dropping. They panic. They sell at the bottom. They lock in losses. Or worse, they get conservative with everything and miss out on massive growth opportunities because they're too scared to take any risk at all. The two-bucket system solves this. Your long-term bucket never gets touched during market crashes. You got 5 to 10 years of expenses already locked in safe investments. So when stocks drop 30% in a recession, you don't have to sell. You can wait it out. You can even buy more while everything's on sale. Meanwhile, your risk bucket is doing what it's supposed to do, taking big swings. Some will hit, most won't. But that's okay because your core wealth is protected. Tiger 21 members hold 12% cash historically. That's way higher than most investors. Why? Because cash gives them the ability to pounce on opportunities without selling their best holdings at the wrong time. They're not forced to liquidate stocks during a bear market to pay bills. They've already got cash set aside. This is the ultimate luxury, having options when everyone else is panicking. Here's what money actually solves with the two-bucket system. Fear of taking calculated risks. When you know your retirement is safe, you can take bigger swings with your risk capital. You're not paralyzed protecting every dollar. You can invest in that startup your friend is launching. You can buy Bitcoin when it dips. You can make aggressive bets that could change your life. Because even if they all go to zero, you're still okay. The second thing it solves is emotional decision-making. Research shows rebalancing a 60-40 portfolio more frequently actually reduces returns. Why? Because you're selling winners early and buying losers. But when you separate buckets, you're not forced to rebalance on a calendar. You let winners run in your risk bucket. You let your long-term bucket compound without touching it. You're making strategic decisions instead of reactive ones. So, how do you implement this? Open two separate brokerage accounts. Literally different accounts with different purposes. Put 80 to 90% in your long-term account. Vanguard index funds, real estate investment trusts, treasury bonds, stuff that's boring and reliable. Set it and forget it. Then put 10 to 20% in your risk account. Coinbase for crypto, angel list for startups, individual growth stocks, whatever excites you. Automate contributions to both buckets. Every month when you get paid, transfer money into each account based on your allocation. Don't think about it. Just automate it. Your long-term bucket gets the majority. Your risk bucket gets the smaller amount. Over time, this builds massive wealth in both areas. The wealthy understand this instinctively. They don't put their whole net worth into one basket. They separate safe from speculative. They give themselves permission to take risks with money they can afford to lose while protecting the core of their wealth. That's how they sleep at night during market crashes. That's how they make aggressive bets without blowing up their lives. If you're watching this and all your money is in one account, you're making investing way harder than it needs to be. Separate your buckets. Give yourself permission to take risks with a small portion. Protect the majority with boring, reliable investments. That's how you build real wealth over decades without losing your mind during every market swing. Subscribe because we're breaking down exactly how the ultra-wealthy think about money. Comment and tell me what percentage you're putting in each bucket. Let's figure this out together. See you in the next one.